If you're wondering how to get more money into your 401k plan, then you'll want to watch this video. In this video, I'm going to talk about 4 ways that can help you to maximize the contributions into your 401k plan. And also, one of those ways is a way that you might not be aware of that could allow you to put even more money into your 401k plan than the standard 401k contributions allow. Welcome back. This is episode 245. As we get close to the end of the first quarter of 2025, it's a good time to review your contributions going into your retirement accounts, specifically your company-sponsored retirement accounts. And if your goal is to maximize what you're contributing into your workplace 401k, whether that be a 401k, a 403b, or a 457 plan, in this episode, I'll review 4 ways that can help you get the most money or allow you to contribute the most money into these plans. Now, it's hard to believe I'm coming up on 5 years of having my Retire with Ryan podcast, and I've had tremendous success with the show, and I want to thank all of my loyal listeners. However, I know I can reach even more people with these episodes that I record each week. And to do that, I need your help by leaving me a review. There are 2 places that I would appreciate you possibly leaving me a review. One is on Apple Podcasts, and the other is on Spotify. So if you have Apple Podcast on your phone, if you have an iPhone, you have Apple Podcast. If you could pull up the Apple Podcast app on your phone, find my show. If you're not already subscribed to it, then you can search Retire with Ryan. Click on it, then scroll down to the bottom, and you will see ratings and reviews, and you can click on Tap to Rate to leave me a review. Now, if you don't have an iPhone or you're listening on Spotify, this is a little easier. You can find my show by also searching Retire with Ryan. Then you actually go to the top, and just under my show, you should see click on rating. And from there, you can click on and leave me a rating. I would greatly appreciate it because the more ratings I have, that allows me to have greater visibility with my show and to allow even more people to find my show. So this week we're going to talk about how to maximize your contributions into your workplace retirement plan, whether that be a 401k, a 403b plan, or a 457 plan if you work for a nonprofit organization. For simplicity, I'm just going to simply refer to these as 401k. And 403b, 457, and 401k have many of the same contribution limits and similarities, but there are some subtleties, and I'll mention a few of those. But you'll also want to check with your employer or whoever's managing your plan to find out what those specific provisions are. So the first way that you can contribute the maximum into your 401k plan is for someone under 50. And the maximum for 2025, the maximum employee contribution is $23,500. Now, if you get paid twice a month, that contribution limit divided by the number of pay periods you would have for the year, which would be 24, would be $979.16 per pay period that you could contribute if you want to hit the maximum. If you get paid every 2 weeks, so that would be 26 pay periods a year, 23,500 divided by 26 is $903.84 per pay period. So you might be able to specify the dollar amount that you want to contribute each pay period, or you might have to use a percentage. Say, for example, that you earn $100,000 in 2025. That would be an easy contribution to calculate. That would be 23.5%. 23,500 divided by 100. And if you earn, let's say, $125,000 a year and you wanted to contribute the maximum, that would be 18.8% to contribute the maximum. So you get how you would do this simple calculation to then figure out the percentage that you want to contribute if your goal is to contribute the maximum. Some plans do allow you to click a button that says contribute the maximum, but most of them you either have to specify a percentage or a dollar amount. So let's say you're listening to this, you didn't realize that you're not contributing the maximum to the plan and you want to contribute the maximum. But we're already, as I mentioned, at the end of the first quarter, so you don't have an entire year to contribute the maximum. So you would first need to calculate how much you want to contribute for the remaining year. and then how many pay periods you have left in the year to calculate how much you need to have go into your 401k plan each pay period to hit the maximum for 2025. So let's just say, for example, you want to contribute an additional $20,000 for the remaining 9 months of the year, and you get paid twice a month, so you have 18 pay periods remaining. You divide $20,000 by 18, and that would tell you how much you need to put in each pay period to hit the maximum for 2025. So that would be $1,111.11. So if your employer does allow a specific dollar amount, then you could put in the dollar amount wherever you go to change your contributions. Usually you do this by logging into your 401k plan. Sometimes if you don't have an integrated 401k, meaning it's integrated with the payroll provider, you might have to do it through your payroll provider. But regardless, if you find out you're not going to contribute the maximum, if you just keep contributing what you're currently set up to do, and you do want to hit the maximum, make sure you make that change so that you can hit the maximum before the year is over. So let's just say, for example, your paycheck is $5,300 a pay period, and you wanted to hit the maximum, and you needed to put in $1,000 between now and the end of the year. You divide the $1,000 by 5,300, and that would give you the percentage that you want to contribute for the remainder of the year. Now, if that's a higher percentage that would put you at a higher amount than the planned limit for the year, you could leave that going into next year, and you still would hit the plan maximum. You just would hit it sooner, so you might have some paychecks that didn't include the 401k contribution, or you could go back at the end of the year and adjust your contribution for the beginning of the year. Now, let's move on to the second way that you could contribute more into your 401k plan, and that would be if you're over 50 years of age. So if you're over 50 years of age, your 401k plan most likely allows for a catch-up contribution of an additional $7,500 above and beyond the standard $23,500 contribution. So that brings your total contribution to $31,000 for 2025. So again, if you're not contributing the maximum, including this catch-up contribution, and you want to do that, you'd want to then recalculate how much you need to contribute between now and the end of the year so that you do hit the maximum. And this is why I'm recommending doing this now, because you have more time between now and the end of the year. If you wait until October to do this, it could be really hard for you to contribute the maximum because you don't have as many months left in the year to adjust to hit the maximum if that's your goal. And for many people, especially those closer to retiring, it's probably going to make more sense for you to be contributing on a pre-tax basis, because that's allowing you to deduct that income that you contribute into the 401k plan from your federal taxes and your state taxes if you live in a state that has state income tax. So that's really the examples that I'm giving here. You certainly could also do this to the Roth account if your 401k offers a Roth option, but I'm talking about doing this on a pre-tax basis. So option number 3 for putting more into your 401k plan is that if you're between the ages of 60 to 63, there's what's known as an additional catch-up or a super catch-up that just went into effect as of the beginning of 2025. So this came as of the Secure Act 2.0 that was passed and went into effect at the beginning of this year. So instead of a $7,500 catch-up, you can contribute $11,500. So there's an additional $4,000 that you could contribute if you're between the ages of 60 and 63. However, your plan doesn't have to allow this, meaning there are some 401k plans that might not have amended their plans to allow for this new provision. So they might still be stuck at the original catch-up for those over 50 of $7,500. So you need to check with your 401k plan to see if it allows this. And if it does allow this, then just like the example I gave earlier, let's say you're not going to hit this maximum because you haven't adjusted your contributions, then you'd want to make those adjustments in your contributions so that you do hit this maximum limit. It would give you the maximum deduction that you could get on your 401k if you put in the $23,500 plus the $11,500 that you could have on your taxes for 2025. So you'd use the same steps as I laid out above. So option number 4 for putting more money into your 401k plan would be if your plan allows for after-tax contributions above the plan contribution and catch-up contribution limits. So how might your plan be able to do this? Do they have some special power? No. You might not be aware. The IRS has a total contribution limit of $70,000 for 2025 between employee and employer contributions. So that is on top of, or I should say, you can also contribute the catch-up contribution in addition to that $70,000. So if you're over 50, you could contribute an additional $7,500 on top of the $70,000 for 2025, bringing your total contribution for 2025 between your contributions and your employer to $77,500. So these are any monies your employer puts into your plan, whether that be a profit-sharing contribution or just the standard employer match that your plan might have. So say, for example, you are 60 years of age and you're projected to earn $180,000 this year working for a company that allows after-tax contributions into the 401k plan. You are then set up already to contribute the maximum into the 401k plan, the pre-tax maximum of $23,500, and then you have already switched over to the super catch-up contribution of $11,500. And your employer has a standard 401k match of 3%. So if they have a standard 401k match of 3%, they would put in then $5,400 of your $180,000. So that then brings your total contribution for 2025 right now between your contribution and your employer's to $40,400. A lot of money. But remember, the maximum contribution this year between your money and what your employer puts in is $77,500. So you can contribute an additional $37,100 for 2025 on an after-tax basis. What that means is that this money is going to be taxed first, and then it goes into your plan. So if your goal was to do this, it would cost you more than $37,100 to put this money in the plan because you first have to pay state and or federal income tax on this plan. So to really make the most of this, if your plan allows for it, to make the most of these after-tax contributions, you'd want to be able to do in your 401k plan what's known as an in-plan conversion to a Roth 401k with this after-tax money. That means that after you contribute the money in the after-tax account, you then move it over to the Roth account, the Roth 401k. That means any growth above and beyond your contributions, above and beyond this $37,100, would be going into the Roth account so that this growth would then be able to, you'd be able to withdraw it in retirement tax-free. So this would be phenomenal to have both the contributions be tax-free and also the growth on the money be tax-free. So let's say your plan doesn't allow for in-plan Roth conversions. Then that would mean that the after-tax money would be tax-free, but the growth on the money would not be. So the growth on the money would then be going into your pre-tax account, into your 401k. So you would pay tax on that money when it comes out, but then whenever you retire from the company or you separate from the company, you could then roll over your 401k, and at that time you'd want to separate the pre-tax money and the post-tax or the Roth money. In the post-tax money or Roth money, you'd set up a Roth IRA, or if you had another Roth 401k at a new job, you would then contribute into that account so that the growth on that money would then be tax-free. So it is something that you really need to check with your employer plan to find out, do they allow for after-tax contributions? There are a number of employers that do. I found a list of 50 employers on the internet that I'll share that from the most part, it does look like more technology-based companies, but that doesn't mean that your company wouldn't allow it. I believe locally where I am, Raytheon is one company that allows it, but CVS is also a large employer in Connecticut, and I checked and I don't believe they do. So you have to check with your plan to see if they allow this, but it is a great way for you to save additional money and do it in an automated way. It's coming out of your paycheck each pay period. It can go into the after-tax account, and then if they do allow for those in-plan Roth conversions, then even better. The only thing you want to be aware of is that I've talked about something before as a way to have special tax treatment on employer stock. If you own stock in the company that you work for in your 401k, you've made a lot of money on it. It's called, you could take advantage of the gain by paying a lower tax rate through something called net unrealized appreciation. I've talked about it in past episodes. If you do perform an in-plan Roth conversion, that does void your ability to use this net unrealized appreciation tax treatment. So just be aware of that before you go and do this. But if you don't own employer stock in your 401k plan and you don't want to take advantage of this, then don't worry about this provision, but it would potentially void it. So lastly, we're talking about this after-tax money going into your 401k. It's called sometimes the mega backdoor Roth IRA. It's a great thing to do. It allows your money to, for you to save even more money into your 401k, you to get more growth on that money potentially. But the limitation is with any money going into a 401k, generally you have to be 59 and a half years of age before you can access that. So what if you want to save even more money for retirement but don't want to be restricted as to when you can access this money? Well, you could use just a simple taxable brokerage account. Anybody could open one. I've mentioned before that my client's money is held with Charles Schwab. You could open a taxable brokerage account with Charles Schwab, and there's no contribution limit. You could put as much money as you want into that account. You also have access to it at any point. You don't have to wait until 59 and a half to access that. So to get the most out of this, I would suggest investing in index mutual funds, index stock mutual funds, or index stock exchange traded funds, or ETFs. Why stock funds and mutual funds, or I should say index funds? Because with stock funds, if you own a stock fund in a taxable account, you only pay taxes each year on the capital gains, dividends, and interest. And stock funds, I should have said dividends or capital gains. Stock funds, you're going to have to pay taxes on the dividends each year, but unless you trigger a capital gain, you're not going to have to pay tax on it. And that's why I recommend using an index fund, or even better, an ETF, because ETFs generally don't create capital gains unless you trigger them. So how do you trigger a capital gain? Why you sell the fund. So if this is long-term, you're investing for the long term, you could just be consistently buying these ETFs. Every pay period, you could have money directly deposited into your taxable brokerage account. You then go in and buy the ETF, and then you just keep doing that until your retirement. And over the course of whatever that period was, you'd only be paying tax on the dividends because you didn't create a capital gain. You never sold. So now you go into retirement. At that point, you start to live off this money. Then you could trigger the capital gains, and at that point, you would then pay tax on the capital gains. For many people, unless you're in the top tax bracket, you're going to be paying capital gain tax rates at 15%. And then if you can stay in the lowest two tax brackets currently, capital gains are taxed at 0%. So that's a significant tax savings. It functions very similar to having it go in the after-tax account and then converting it over to a Roth IRA or Roth 401k. So it is another option if your plan doesn't allow after-tax contributions, or you just don't want to worry about having the money tied up until you're 59 and a half. Use a taxable brokerage account, invest it in ETF stock funds, and use index funds, I'd recommend, and you could have yourself set up for an additional way that you could generate income in retirement. So I hope you found this episode helpful, and if you did, please leave me a review on Apple Podcasts or Spotify, as I mentioned earlier. Have a great week, and I look forward to talking with you next Tuesday. Take care.